3 of the Form 926. It is this page that gives a checklist. Ideally, the client is in communication with you and he says, hey, I'm doing something outside the country. When he does, you want to grab this form and go to page 2 and page 3. Page 2 is the easiest part of the checklist. It uses plain language. You can really see what's going on. The government really is really simple. What they want is gain. They just want to tax the profit. That's just that simple. You see, for cash, gain is blanked out. That's not going to happen. So there's a list of assets that the government historically has seen be transferred offshore. Usually it's to either save some money or start a business in a country with a lower tax than the United States that will save some money. And you want to go through this checklist with your client to do some planning. Keep in mind, Form 926, as we talked about, is when the assets go in as capital. It can be for common stock, can be preferred stock, or just a straight capital contribution. We see that as tax-free under Section 351. When in the old days, or even with the S Corp, we just put assets in the corporation. Maybe we issue some shares for some cash of $1,000, and the rest of the assets go in. Rarely are we doing part note and part debt. But with the foreign transaction, you may want to do that. Now, keep in mind the thin capitalization rules are very important. We're going to get to that in this talk. The IRS has been successful in busting some major companies, either Packard for one, Pepsi-Cola, that did not understand the thin capitalization rules. I have on my PowerPoint a recent case about a small business. It's a lot easier to understand that fact. And the court does something interesting with thin capitalization, which is debt versus equity. The court ignored Section 385, which is a code section enacted 30 years or so ago, to define this concept. The court goes to strictly a common law concept. Common law means a tax law created by court cases. It makes it harder for accountants. We like things black and we like things white. We don't like this fuzzy court stuff. Ken Barish loves the fuzzy stuff. Installment obligations. That's more like the company has installment obligation from an unrelated party, not an installment sale. Foreign currencies, you're going to see that when the client already has a branch going in a foreign country he wants to incorporate. When you see a branch in a foreign country he wants to incorporate, you want to keep in mind that there's a recapture rule of losses from the branch when you transfer the business to a foreign corporation. That is in Section 367. Inventory gets really complicated because of the different tax accounting rules for inventory. Assets subject to depreciation, recapture, that's pretty straightforward. Tangible assets not used in a trade or business, rarely do I see that. I'm not even sure what that would be, but it's there. Intangible property, this is the one that's new for this century because almost all of our clients have a website. From that website, you have a common law trade name, a common law trademark. You may have special coding for your website. You may have a blog like me with a lot of content. And if that website is e-commerce or is helping the person in his business, the transfer of the essence of it, its appearance, can be a taxable event, and intangible assets have a special rule under Section 367. That's the law that treats a transfer of appreciated property to a foreign corporation as taxable income. That's why we have the gain column over here. The gain, gain, gain is what they want. Lease property, and as we get to these last three, you're going to see a lot of reference to Section 367. We'll see it more on the next page. This checklist form requires you to have your computer screen open next to you and these code sections up so you can really help your client. With great planning, the client can transfer his foreign business offshore and do it tax-free. We see it with inversions, we hear about it, and it can be done. You just have to plan in advance. When we get to the next page, you can see the IRS is really starting to drill down to get information. Is there an increase in ownership or even a decrease? If you think it's tax-free, what's the code section? Because there's not any real code section that's going to make it tax-free unless you, I should say, there's a few, and they're in the instructions, but for the most part, there's not going to be any. This has to do with foreign tax credit recapture, and so if the client's been getting foreign tax credit, you really want to spend a lot of time with this and plan this out. To repeat myself, this form is what you pull out when the client's just thinking about it, and you really are doing the planning, and the client hopefully appreciates the value that you're going to be giving to him by avoiding taxation in the current year, the year where he has no cash, he just transferred assets. Change of classification, this would be disastrous. If you were to go from a corporation to a disregarded entity outside the United States, you would have created a huge domestic tax problem. So once again, these are trick questions. You don't want these questions to to trick you out, because these really are questions to tell the IRS to get to you. The branch loss recapture, that is, once again, when the client has an operating business in a foreign country, he's now going to incorporate it. Any other, this is the stuff from the CPA. Any other, this is like, there's no end to how much work we'd have to spend on this. And the hard part is to explain your client. Look at this line, any other, so that the client can understand that you are the one signing off on this. In exception to the penalties, you have to keep your work papers in the file showing that before the client did the transaction, that your research shows that he did not owe tax, or there's a very likely chance he does not owe tax. This is an exception that's used a lot in tax planning. I would really highlight this. This is your way to escape taxation. You surely don't want to fall into foreign goodwill or growing concern value. And growing concern value is a look-back rule. And I was just going to look back and see how successful the business was. If it was successful, it has a growing concern value. And you just want to really plan that out carefully. You want to get an appraisal here. You want to really dot your I's and cross your T's. You can see this is still being watched by the IRS. If yes, what's the amount, because we want to tax you. Was cash the only property transferred? Well, that'd be great if it is, because then the IRS wouldn't get any money from you. And so one planning tool is to fund it with a sufficient amount of cash and do installment sales of the property. And that's one of the most popular ways for a small business to transfer assets outside the country. As you know, the interest rates on related party loans are quite low, and it's really a good method. Intangible property, again, Section 367H isn't as bad as you think. It's the oldest section. It doesn't apply to some of the items such as a website and computer software that's used within a website. You can see the intangible property, though, is really on the list. This is not because of today's web. This is the same questions they've had for decades. They're still looking at copyrights, trademarks, patents, so there's some safety there. So we're going to jump back up to the first page because I skipped that. And there's a little bit there, not too much. The name, if it's the individual, it's the name of the individual, SS number. If it was a corporation, you go through all these other questions. Usually we think this form would have been designed for C corporations, but it is possible that an S corporation could be the one transferring the business offshore. So if it is, you want to go through this. But what I really want to point out to you is not the corporate information, because that's what we would expect if the corporation is the transferor, the corporate name would go in here. But what if it's a partnership transferring it? We most of the time see partnership as a entity, However, the IRS has lost a lot of tax court cases because of that. So the IRS is slowly trying to erode the entity approach and go back to a mid-century of last year approach of the aggregate theory. And the aggregate theory is that when you have a five-man partnership, each partner owns 1/5 of the partnership. Where it gets really hard in today's world is special allocations. So you see what takes place here. If the transfer was a partner in a partnership, now this is interesting because really it's the partnership who's the transferor. The IRS goes back and puts it on the partnership name, EIN, and then of course the question that the CPA really doesn't like, because he's the one who's going to check the box yes or no. Did the partner pick up the gain? Well, you and I believe there is no gain. So this is where we have a conflict with the client, and we really need, because we have the tax penalties. So we have a conflict of interest with the client. We don't want to pay the tax penalty. These laws are vague. We don't know what's going to happen. That's part of the reason my firm always vets a transaction with the IRS National Office in the ruling process. Entire interest in the partnership, that makes it a little bit easier for you if he's, if it's a small partnership. This is uncommon, and not too often you're going to see a client putting an investment into a controlled foreign corporation. So these are the things that we need to look at for our clients. These are the things that are the most difficult for the client. And these are the place where we can give the client the best value. And by value, I mean by doing this stuff in advance, we will save them money and they will be happy to pay us the fee for it. So we're going to go on to some other forums, but we're going to end this one here. Of course, you can always call me after this session. These videos are all online. They're also in the PowerPoint, so you can play them again. You can play them by themselves, or you can play it through the PowerPoint.